Are you new to the share market and looking for some guidance? Well, let's embark on this financial journey together. Picture the share market as a bustling marketplace, a financial hub teeming with opportunities. It's a place where companies come to raise capital by selling parts of their business, known as shares, to you, the public. As a shareholder, you essentially become a part owner of that company. But, like any marketplace, it's filled with both opportunities and pitfalls. That's why understanding the market before investing a single dime is crucial. It's about comprehending the ebb and flow of this financial sea, deciphering the trends, the highs and the lows, and learning to navigate through it all. Yes, it might seem overwhelming at first, but don't worry, we've got you covered. In this video, we will discuss 5 tips for new share market investors. So buckle up and let's set sail on this exciting voyage of financial discovery. Scene script. Tip number 1, understand your investment goals. So, you've taken the plunge into the share market, eager to see your money grow? But wait, have you thought about what you're aiming to achieve with your investments? Yes, you heard it right. One of the most important steps in your investment journey is to clearly define your investment goals. Think of your investment goals as the destination you want to reach with your financial journey. They're the why behind your investing decisions. Without them, you're like a ship sailing without a compass. You might end up anywhere but not necessarily where you want to be. Now, these goals can be as diverse as the investors themselves. Some of you might be investing with a long-term perspective, perhaps for your retirement. You're not bothered by the short-term market fluctuations and are focused on building a substantial corpus over the years. On the other hand, some of you might have short-term financial goals. Maybe you're saving up for a dream vacation, a new car, or a down payment on a house. In such cases, you might be looking at investment options that can give you quick returns. Then there are those of you who might be investing for income generation. This could be especially true for those nearing retirement, who want a steady income stream post-retirement. Understanding these goals is instrumental in guiding your investment decisions. Each goal will require a different strategy and a different risk tolerance. A long-term goal might allow you to take more risks and invest in high-growth stocks, while a short-term goal might require a more cautious approach, focusing on stable and reliable returns. So, take a moment to think about your goals. Are you looking for growth, income, or stability? Are you investing for the short term or the long term? Do you have a specific financial target in mind, or is it more about the journey? Remember, having clear goals can help you make more informed investment decisions. So, set your sails, plot your course, and let your investment goals guide you to your financial destination. Our second tip is to diversify your portfolio. What does that mean exactly? Well, imagine you have a basket and you want to fill it with fruits. Would you fill it with just apples? Probably not. You'd want a variety of fruits to enjoy. Similarly, in the world of investing, diversification means spreading your investments across different types of assets to reduce risk. Let's delve further into this idea. When you invest all your money in a single stock or sector, you're exposing yourself to a high degree of risk. If that stock or sector performs poorly, your entire investment could take a hit. This is akin to putting all your eggs in one basket and then dropping that basket. Not a great situation, right? But when you diversify your portfolio, you spread that risk. You invest in a blend of stocks, bonds, commodities, and perhaps even real estate. These different types of investments often perform differently under various market conditions. When one might be down, another might be up. This balance can help smooth out the financial bumps in the road. Consider it like a well-balanced meal. You wouldn't just eat potatoes for dinner every night, would you? No. You'd want a mix of proteins, carbohydrates, vegetables, and so on. The same principle applies to your investment portfolio. You need a balanced mix of investments to ensure you're not overly exposed to any one type of asset. However, remember that diversification is not a one-size-fits-all concept. The right diversification strategy for you depends on your individual financial goals, risk tolerance, and investment timeline. A younger investor might be able to take on more risk and therefore have a more aggressively diversified portfolio. An older investor, closer to retirement, might prefer a more conservative approach. So the key takeaway here? Don't put all your eggs in one basket. Spread your investments across different types of assets. It's like having a safety net under your financial future. A diversified portfolio can help you weather the ups and downs of the market. Moving on to tip number 3, do your research. This is not just a tip, it's a cardinal rule in the world of investing. Without research, investing is like driving blindfolded. You wouldn't know where you're going, and the ride could end disastrously. When it comes to investing, knowledge is power. But where do we acquire this knowledge? There are numerous resources at our disposal. Financial news is one such resource. It keeps you updated about market trends, economic events, and changes in government policies that could affect your investments. It's important to read widely, not just about the companies you're interested in, but also about the broader economic landscape. It's like a puzzle. Every piece of information helps you see the bigger picture. Then we have company reports. These are like report cards for companies. They provide insights into a company's financial health, its performance over the years, and its future prospects. Look for things like earnings per share, debt levels, and profit margins. Remember, a healthy company today does not guarantee a healthy company tomorrow. Hence, regular monitoring and evaluation of these reports is necessary. Investment analysis platforms are another valuable resource. These platforms provide detailed analysis of different companies and sectors, helping you make sense of all the information out there. These analyses are often conducted by experts in the field, so they can provide valuable insights that you might not be able to glean on your own. In this digital age, we also have forums and online communities where investors share their experiences, insights, and tips. These can be great places to learn from others' successes and mistakes. But remember, while advice from others can be useful, it's crucial to do your own research and make your own decisions. One word of caution though, while research is important, it's not about finding a surefire winning stock. It's about understanding the risks and rewards and making informed decisions. Doing your research can help you make more informed investment decisions. So get curious, ask questions, dig deep, and arm yourself with knowledge. After all, the more you know, the better your chances of success in the share market. Tip number 4 is don't follow the herd. It's a simple enough concept, but one that's often overlooked in the hustle and bustle of the market. The financial world is a complex, constantly changing landscape, and it's easy to get swept up in the tide of popular opinion. But following the herd, or blindly chasing market trends, is a dangerous game. You see, the stock market isn't a popularity contest. It's a dynamic, unpredictable entity that rewards strategic thinking, not simply going along with the crowd. Let's consider this. When everyone is buying, prices soar. When everyone is selling, prices plummet. But who's to say when the tide will turn? Who's to say when the next market bubble will burst? The herd mentality can lead to inflated prices and market bubbles, which can result in significant losses when they inevitably burst. But here's the thing, you're not a sheep, you're an investor. And as an investor, you need to cultivate an independent mindset. You need to be able to stand on your own 2 feet, make your own decisions, and steer your own course. This isn't to say that you should ignore market trends completely. On the contrary, they can provide valuable insights into the current state of the market, but they should never be the sole driver of your investment strategy. Instead, they should be one of many tools in your arsenal, complemented by thorough research, a clear understanding of your investment goals, and a diversified portfolio. So, don't be swayed by the latest buzz or the hottest tip. Don't let fear or greed cloud your judgment. And most importantly, don't let the actions of the herd dictate your investment decisions. Instead, focus on your own goals, concentrate on your own strategy, and trust in your own judgment. Because at the end of the day, You are the one who will reap the rewards or suffer the consequences of your investment decisions. Remember, it's your money, and you should make the decisions that are best for you, not what everyone else is doing. Our final tip is be patient. Now, this is where the true essence of investing comes into play. Investing in the share market is not a sprint, it's a marathon. It's not about making quick profits overnight. It's about watching your investments grow over time. Market fluctuations are as natural as the changing of the seasons. They are a part of the economic cycle and are completely normal. It's important to remember not to panic when the market takes a dip. Instead, take a deep breath and remember your long-term goals. If you've done your research and invested in solid, reputable companies, then trust in your decision-making. It's like planting a seed. You don't expect a tree to grow overnight, do you? It takes time, nurturing, and yes, a whole lot of patience. Remember, Rome wasn't built in a day, and neither will your investment portfolio. So, stay calm, stay focused, and stay patient. Patience can be a virtue when it comes to investing in the share market. And there you have it, 5 tips for new share market investors. Let's quickly jog our memory. First, understanding your investment goals is crucial. It allows you to determine why you're investing and what you hope to achieve. Second, diversify your portfolio. Spreading your investments across various assets can help mitigate risk. Third, always do your research. Informed decisions are often better decisions. It's essential to understand the companies you're investing in, their performance, and their potential growth. Fourth, don't just follow the herd. It's easy to get swayed by popular opinion, but remember, what works for others may not work for you. Lastly, be patient. Investing is not a get-rich-quick scheme. It's a long-term game. It takes time to see significant returns on your investments. Remember, investing is a journey that requires patience, research, and a clear understanding of your goals. Happy investing!